Are you ready to build some real, lasting wealth through real estate, but you feel completely stuck? Paralyzed by the fear of trusting the wrong person, misjudging a deal, or making a huge mistake with your hard-earned money? Well, in this video, I'm going to share the SMART investing framework that I've used personally to successfully invest in thousands of managed apartments. And at the end, I'll share a free resource that'll help you mitigate risk and invest with confidence. I've been there. I can still feel what it was like, staring at a potential investment packet, overwhelmed by the spreadsheets, the jargon, and the sheer weight of the decision. I knew one path could lead to financial freedom, while the other could drain my bank account and set me back for years. Was I about to make a life-changing move or a devastating error? That constant anxiety, that analysis paralysis, it all changed for me when I stopped searching for the perfect deal. Instead, I started using a simple 5-letter framework that acts as my compass every single time I invest in an apartment. It's the system that lets me cut through all the noise and focus on what really matters. In this video, I'm going to share my SMART investing framework that separates the winning apartment deals from the ones that will drain your bank account. By the end, you'll have a clear, actionable blueprint to invest with confidence and finally start building the passive income that you deserve. So if you're ready to stop worrying and start building, hit that like button and subscribe because we're going to get started right now. The first letter in our framework, S, stands for structure. This is the absolute foundation of any passive investment, and it's shocking how many new investors just skim right over it. The structure is the deal's legal and financial blueprint. It dictates exactly how you, the passive investor, get paid and what rights you have. So when a syndication team, also known as a sponsor or general partner, puts a deal together, they create a legal entity, usually an LLC. As an investor, you become a limited partner, and they act as the general partner who manages the whole project. But here's the key. Not all structures are created equal. The very first thing you need to look at is the equity split, or what's called the promote. This is just how the profits are divided between you, the passive investor, and the sponsor. You might see a 70-30 or an 80-20 split, where the investors get the bigger slice. That's common, but the devil is always in the details. And those details are in what's called the waterfall. This is just the sequence of how cash flow and profits are paid out. A critical feature to look for is a preferred return. A preferred return, or a pref, is the threshold that says investors get paid first, up to a certain percentage, say 6 or 8%, before the sponsor starts taking their cut of the profits. This is crucial protection for you, the passive investor. It ensures that the sponsor is focused on making sure the property performs, and you get a return before they get a major payday. And while a pref is good, you need to know if it's cumulative. Meaning, if the full preferred return isn't paid out, does it carry over to the next year, or is it gone forever? You also need to understand the exit strategy. Is the plan to sell in 5 years or 7 years? Is there a plan to refinance and give you back some of your initial capital? This should be clearly spelled out. Understanding the structure is not just about reading a document. It's about knowing how and when your money is supposed to come back to you and what safety nets are in place. Next up in our SMART framework is M, for model and assumptions. This is where we get into the numbers, but don't let that scare you. This is where you double check the story the sponsor is telling you. The financial model is just a spreadsheet that projects the investment's future performance. But a projection is only as good as the assumptions that it's built on. Your job is to be a detective and question those assumptions. For example, the sponsor will project future rents. Ask if they're realistic. Ask for the rent roll. That's the list of all the tenants and what they're paying right now. Then compare the sponsor's projected rents to similar apartments right there in the same neighborhood. You can use market data or even just check rental listings online. If they're projecting a 15% rent bump in year 1, you need to see a very clear and believable plan for how they're actually going to get there. Look at the occupancy rate. If the property is 90% occupied today, but their model assumes 97% occupancy for the next 5 years, is that realistic for the area? What about expenses? A common mistake is underestimating costs. Are they budgeting for property taxes, insurance, and maintenance to go up over time? Property taxes are usually reassessed at regular intervals. So will the property be reassessed during the hold period? And does the plan account for that? A conservative budget will show expense growth by at least 3 to 4% each year. And maybe the most important assumption of all is the exit cap rate. The cap rate measures a property's profitability, and the exit cap is what they assume they can sell it for later on. It's calculated by dividing the property's net operating income by its current market value. The result is expressed as a percentage. So say, for example, if a property earns $10,000 a year after all of its expenses and it's worth $100,000, the cap rate is 10%. A huge red flag is when the sponsor assumes they'll sell at a lower cap rate than they bought it for. A lower cap rate means a higher price, which inflates the projected returns. A safer, more conservative assumption is that the exit cap will be the same or even a little higher than what they paid. This builds in a margin of safety. Remember, you're not trying to become a financial analyst overnight. You're just stress testing your numbers to see if they hold up to common sense checks. All right, I know this can feel like a lot. Vetting the structure and the model is the hardest part for most new investors. To help you out, I put together a free S.M.A.R.T deal analyzer checklist. It walks you through these exact questions so you don't miss a thing. You can download it for free using the link in the description below. It's the tool that I wish I had when I started, and it will make this process so much easier to handle. The third letter, A, stands for alignment of interest, and this might be the most important human element of the whole entire framework. Alignment just really asks one question: are the sponsor's interests tied directly to yours? In other words, do they make serious money only when you make serious money? The number one sign of alignment is when the sponsor invests a significant amount of their own cash right alongside yours. This is called the co-GP investment, and it shows they have skin in the game as well. When the sponsor has their own money on the line, their mindset is different. They aren't just managing your money, they're protecting their own. You should always ask how much of their own capital the general partners or sponsorship team is putting into the deal. The second piece of alignment is the fee structure. Of course, sponsors should get paid for their work, but the fees need to be reasonable and based on performance. You'll likely see an acquisition fee, maybe 1 to 3% of the purchase price, for finding and closing the deal. This is pretty normal. There will also be an asset management fee for overseeing the property, usually somewhere around 2%. These are all standard, and it takes a lot of time and effort to acquire and manage these assets. The sponsor needs this revenue to support their operations. But the key is that the bulk of the sponsor's compensation should come from their share of the profits, that equity split that we talked about earlier. This keeps them focused on maximizing the property's performance to deliver strong returns to you, the passive investor, not just collecting a large acquisition fee and heading for the exits. Finally, alignment is about communication. A good sponsor provides regular, transparent updates, at least every quarter, on how the property is doing. Ask them to provide you with a sample report to see the types of information that they regularly provide. They should be easy to reach and willing to answer any of your questions. If you ever feel like you're just getting a sales pitch or they're being vague, that's a huge red flag. True alignment means you are partners, and that requires trust and transparency. The fourth letter, R, stands for risks. Every single investment has risks, and anyone who tells you otherwise is lying. The goal is not to find a no-risk investment because they just don't exist. The goal is to identify all the potential risks, ensure you understand what they are, and make sure there are smart plans in place to handle them. First, there's market risk. What happens if the local economy slows down or a big employer leaves town? A good sponsor has already researched this and chosen a market with a diverse job base and a growing population. Then there's property-specific risk. You have to review the due diligence reports. This means looking at the property's inspection to find any major repairs that are needed, like an old roof or an aging HVAC system. You'll also want to see an environmental report to make sure the land is clean, and a title search to ensure that no one else has a hidden claim on the property. The sponsor should make these reports available to you. You can find them in the investor portal. There's also financing risk. What kind of loan does the property have? Is it a fixed rate loan or a variable rate loan that could get a lot more expensive if interest rates go up? What's the loan to value ratio, or LTV? A higher LTV can juice returns, but it does come with more risks. More leverage means a higher debt payment, which means if occupancy falls too low, the sponsor is probably going to have trouble making debt payments. Ask them what the break-even occupancy is. A more conservative loan to value, maybe around 65 to 75%, gives you a bigger safety cushion if the property values dip. Finally, there's the operational risks. What if the management company does a poor job? What if the renovation budget is too small? Ask the sponsor about their contingency reserves. A well-run deal will always have a rainy day fund set aside for unexpected costs so that no one surprise sinks the whole project. By systematically identifying these risks, you turn unknown fears into known variables that you can plan for. This brings us to our final letter, T for team. At the end of the day, you aren't investing in a building. You are investing in the people who are going to run it. The experience and integrity of the sponsorship team is the single most important factor for success. You need to investigate their track record. How many deals have they taken from start to finish? A sponsorship team who has navigated multiple real estate cycles, both good and bad, is far more valuable than one who has only ever seen prices go up. Ask to see their track record, including any deals that didn't go as planned. An honest sponsor will be open about their mistakes and what they learned. And who else is on the team? It's not just about the main sponsors. Who is their property management company? Do they have a great reputation in that specific market? Who are their lawyers? Who are their accountants? A professional team uses other professional partners. Finally, check their references. Ask to speak with other passive investors who have worked with them. A strong team will have a long list of happy investors who can speak to their competence and their character. And remember, a great property in the hands of a bad team will almost always fail. But even a mediocre property in the hands of a strong team can become a home run. You're betting on the jockey, not on the horse. So there you have it. The 5-letter S.M.A.R.T framework for passive apartment investing. S for structure. Know how you get paid and what protects you. M for model and assumptions. Stress test the numbers and check the story. A for alignment of interest. Make sure they win only when you win. R for risks. Identify every potential challenge and the plan to fix it. T for team. Bet on experienced, trustworthy people. By using this framework, you stop being a hopeful speculator and become a savvy, informed investor. You replace fear with logical process, and that lets you make confident decisions. You no longer have to guess who to trust or how to size up a deal. You have a system. The path to building wealth in real estate isn't about finding some secret once-in-a-lifetime deal. It's about consistently applying a proven framework to find great opportunities. To help you apply this framework right away, don't forget to download your free S.M.A.R.T Deal Analyzer checklist from the link in the description below. It'll guide you through this whole process step by step. Thanks so much for watching. And if you got value out of this video, do me a favor and like, subscribe, and hit that little notification bell so you don't miss the next video. Now get out there and start investing smart. I'll see you in the next one.